2 and 1. Well, good afternoon, and after a short delay, transitioning here, as you can see, we are getting our day started with the Real Estate and the Economy podcast for this week. Now, if you were tuning in to last week's episode, you might have realized that we went dark, and we had special things that needed to happen last week, so we didn't have our episode, but this will continue on with our series with Miguel, aka Francis, actually the armchair economist, now wanting to go by what?
The blind economist, yeah.
The blind economist.
The blind leading the blind, yeah.
A very appropriate use of what you're looking for, man. So why the name change, Mike?
I did a little research, and there was the last blind economist. There was a blind economist that used to do episodes, etc. He was 80 some years old. He died Christmas Eve of 2013. So I decided to take his spot. Yeah, okay. The spot was open. So yeah. And it gives, being blind gives you an interesting view on things, right? Get it? Yeah, so.
Yes, all the visual puns that go with it.
Yeah, exactly. Yeah, I love it. Yeah. So today we're going to talk a little bit about the Federal Reserve, and I just wanted to give you a quote I heard about the Federal Reserve. Trying to understand the Federal Reserve is like trying to understand Shakespeare in its original Klingon.
Klingon. That's a Star Wars joke for those of you who don't know that.
Star Trek.
Yes, my bad. You see, that's how terrible of a cultural reference.
Let's start with the basics. What time is it where you are in Japan?
Currently, approaching 6 o'clock
in the morning.
Yes, and this would be Wednesday morning here in town. And actually, the sun rises here at 4:45 a.m.
Oh.
So it makes it that much more fun. But man, what a beautiful country to be in, and it's great to be here with the boys, be able to enjoy and explore that experience with them. So part of the reason why this format on the Zoom is here today. So yeah. Well, to get us started, man, I wanted to quickly talk about the real estate market update. When we talk about the national market update, we know that a lot of the activity that's been happening over the last couple of years has really been unique in the sense where 21 and 22, we really can't use those as measuring factors according to what the current market is performing in, let's say. So one way to really define 21 and 22 is to call them a unique name, something like a unicorn, because they just don't happen every so often. In fact, we had the best performing 2 years in real estate ever during those 2 years. So when it comes to like measuring the market and trying to understand what the current market is doing, it would be more appropriate to reference what was happening in normal stages the years previous. And so when we take a look at what the current activity is so far this year, we know that the first half of the year, the last half of last year, we've had prices decline, expected, normal, healthy for the economy because it was not sustainable in the direction that it was headed. But what we have seen in the last couple of months, and what we've been talking about here since April, has seen what we consider to be the flatline bottom, if not starting to see some price appreciation in Las Vegas, as well as nationwide. In fact, all of the forecast sources for real estate are showing month-over-month appreciation in all markets across the country, which goes to reinforce the fact that the real estate portion of the economy is not just resilient, it's still very strong. And the reason why we need to factor in the previous years of performance pre-COVID, let's say, the unicorn years, is so that we can really understand where we're at in our market space right now. We are still not meeting our same performance levels in terms of listing volume as well as activity as it was pre-pandemic. And so we still are short in the number of listings nationwide. We are still have strong buyer demand, even with the rates currently sitting around 7% on that. And what that does is it creates a unique situation. If for some reason rates end up falling, and now there is a case for rates to fall, and we'll talk about that in a moment. But right now rates are at 7. If for some reason there is an improvement in the inflation and rates do go below 6%, you can guarantee that there's going to be a buying frenzy. And with the amount of inventory that we have right now, we're going to be right back into 2021 with multiple offers and lines around the corner like chaos that has never been before. So when we take a look at where we're at now, we need to help clients, buyers, sellers understand that we are in a place where the economy is moving. But as far as the real estate market goes, it is strong. And with the rates where they're at now, it is still an excellent time to be able to make that move now, especially as a seller and a buyer. Life happens, things happen, and the goal is to have your life enjoy what it is. So we can help you navigate that course wherever your situation is. And it simply requires a unique consultation for yourself. Regarding the rates and where we're at, we'll elaborate a little further with you on that, Mike. But the rate situation right now is sitting around 7% for mortgages. Is it's about 3% higher than the 30-year Treasury. And the reason why that's important is because traditionally, on average, the spread between the 30-year Treasury and the average mortgage rate is around 1.7% on average historically. Now that's just an average number. It's just a number that economists like to use as far as that spread goes. But why that's important now is because that spread is now over 3%, double. And that just is a reflection of the current state of the economy as far as the transition goes. And that particular moment of having that high rate really identifies us as being in a unique market, because the only other times that's really happened was pre-2008 as well as 1980 when that spread was that wide. And so what that tells us is that there is room not just for rates to drop, but also things to make a change soon. What that is, we're going to wait and find out. But a lot of that has to do now with core inflation. Mike, what's the update on that?
Right. Well, core inflation is sticking high. The CPI numbers came out today, earlier today, and they came in at 5.3. I want to back up just a touch back to mortgage rates. I do have quite a bit of experience in the real estate business because I previously owned that mortgage company, et cetera. And one thing that I used to tell my customers, and it's a common expression in the real estate business, you marry the house, you date the rate. So don't get all hung up on the interest rate, on the rate. You marry the property, but you date the mortgage rate, because the mortgage rate can be replaced. So whatever it is, don't sit around and wait for it to get better. That could end up costing you money.
Absolutely.
But back to, back to mortgage rates. The core CPI number came in at 5.3. And what was interesting about that, it was 0.4 month over month for the third month in a row. Mm-hmm. So the headline CPI number came in at 4.0, which was great, down from 4.1 last month and 4.9 the month before. But the reason headline inflation did so well is because energy went down by 3.6%, largely due to the cost of oil, because there's a grappling between OPEC and Russia supplying large quantities of oil to China, as well as the United States trying to keep oil prices down. So with all of those major global dynamics, oil did dip by 3.6. Well, energy dipped by 3.6%, and that had a major impact on headline inflation. But as we've mentioned previously, headline inflation isn't what matters when it comes to the Federal Reserve. So they look at core inflation because things like energy and food are too volatile to consider when trying to make policy decisions. So
makes sense.
Yeah.
And still the concern is that with the residential side still being mostly strong, there's the commercial side that's still up in the air in not turmoil, but still on the questionable side of things.
Yeah, you got two different things there. You mentioned residential, and of course we're talking about housing. Mm-hmm. Housing was one of the stickier items. If you lift the hood, on the CPI report, housing was up month over month by 0.5%. That's huge. If you annualize that, that comes up to 6%, right? That's high. And so housing was up by 0.5%. That would be rents and purchases of real estate. And that's a huge piece of the CPI number is the cost of housing. And so that's an issue. And how you said earlier that you have a lot of confidence in real estate moving forward the second half of the year, I don't feel quite the same as you. I think it's going to go stagnant to -3. Of course, I'm talking nationally, how it looks specifically to the Las Vegas market. That I don't know. But nationally, I think it's going to be relatively stagnant to -3. However, that's not going to really do anybody any good in terms of the housing expense. It's still going to be pretty high, which means core inflation is going to remain pretty persistent. But the other thing you mentioned was the commercial real estate. And there is a looming commercial real estate crisis. Now, I got, there's 6 major categories for commercial real estate, right? There's retail, industrial, office space, multi-family, hospitality, and special use. So let me ask you, Jared, out of those 6 different groups, which one do you think is the highest percentage of commercial real estate?
What was that list again?
Okay, I'm getting retail, industrial, office space, multifamily, hospitality. In Las Vegas, got a lot of hospitality, and special use. That would be like, special use would be like doctor's offices, religious organizations, self-storage, stuff like that. So we know it's not special use, so throw that one out.
You're looking at probably retail and office space being the highest risk.
You got those. Well, you're right in terms of highest risk. Now, of those two, which one is the largest percentage of commercial real estate? You nailed it.
Commercial. Yeah. Retail, no?
That's what I would think. Retail's like the malls, etc. Right. Not true. The largest percentage of commercial real estate is office space. Isn't that interesting? Wow. You and I are thinking of it in terms of what we see here in Las Vegas. But it's office space, in other metropolitan areas. Office space is 35% of all commercial real estate. Industrial is second at 24, and retail comes in at 18. So It drops off. Yeah, big numbers. So here's the issue. It's office space that has where the crisis is coming from. The big one, the 35% one, it's showing 20 to 25% vacancy rates depending on where you go. It's higher historically than it was prior to the 2008 financial crisis. Wow. So, yeah, it's kind of an issue. And so office commercial space, we've talked about this multiple times in our episodes. It's upside down. It's underwater when it comes to its financing, and there's going to have to be a lot of restructuring of loans, etc. You have the largest segment of commercial real estate that's actually kind of in trouble because people aren't going back to work because they're working from home a lot now. If that becomes a systemic crisis, which I think it has the potential to be so, I would give it a 40% chance of actually impacting, the the national economy at a minimum. Anyway, if in the event that happens, it's going to spread to the regional banks, and we've talked about that previously. Anyway, all of that matters because the Federal Reserve is meeting tomorrow. Jerome Powell and company. And right now, the central bank rate is estimated to be between 5 and 5.25. And the market anticipates that the Fed is going to pause tomorrow. But I only see a pause. I do not see a long-term stopping, a wait and see because of core inflation. The Fed's got problems. They got to deal with core inflation, but they're no doubt acutely aware of the pending or looming possible crisis of commercial real estate, because that commercial real estate crisis will bleed into regional and smaller banks, which are responsible for 80% of the financing in the commercial space. So the Fed's aware of that. So I think they're going to pause. They're going to do it a little bit against their will, because I know they're concerned about the core rate being at 5.3, because that core rate is coming down way too slow. And so the Fed will probably pause tomorrow, but in July, I anticipate it's quite likely that they're going to hike it again. And unless core inflation starts coming down, it's possible they'll hike it twice more, at least this year. What's the name of that Mad Money? Jim Cramer. He thinks it's possible they'll hike it tomorrow. He said to be prepared in the event of a possible hike. And I agree with it. And because when you look at the big picture, core inflation is the most critical thing that's happening right now, because core inflation is something we're facing right now. The commercial real estate crisis is a possibility for the future. So if you're the Federal Reserve, what's your priority? Yeah. Something that's on the table today or something that could be on the table tomorrow? Right. Yeah. So it's complicated times. But anyway, with the idea of the Fed reducing the rate anytime this year, you could take that off the table, And you were talking about
definitely.
Pardon?
With the pace of inflation and how slow it's going.
Yeah, inflation's not going to. Yeah, and one of the factors that's pushing inflation up is housing. Housing is a huge part of it. On top of that, consumers are spending money like there's no tomorrow. They're increasing their debt and they reduce their savings. Yeah. They're spending like there's no tomorrow. So consumer spending is very strong. Housing is very stable and strong. If there's a correction in housing, there's no way I see it going more than 6%. And that's not going to be enough to relieve the inflationary pressures. Just not going to happen.
Sure.
Yeah. And so inflation is the big picture problem, and it's going to last the rest of the year. Now, mortgage rates could fluctuate, and they could drop a little bit, like from 7 to potentially 6 3/8, or 6 1/4. I don't see them going below 6, But again, you marry the house, you date the interest rate of the mortgage. You don't get hung up on mortgage rates.
Very true. One theory that's out there, and I'd like to get your input on, is let's just imagine the office space issue becoming a systemic problem.
Right.
And we continue to have an inventory shortage in the residential space. Converting some of that office space into a residential format might and possibly be a decent solution for the inventory shortage issue. What do you think of that?
That's a beautiful solution in my mind. A little bit challenging. It's already happening in different metropolitan areas around the country. There's a major financial building. I wish I could remember the name of the building. Beautiful building in Chicago. Marble floors, marble stairs. It was a major financial building back in the day, but it's been vacant for many years. They're converting it to residential, but the challenges they face is like in that specific building, for example, in order to get the historical benefits so they can be subsidized by the local government, they have to leave the vault in place. And they have this giant vault. Yeah. Yeah. That takes up like, 3 stories and everything else. So they have to build all the infrastructure around the vault. Is kind of funny. But when going into a commercial space, trying to decide whether or not it's feasible, financially profitable to turn it into residential, believe it or not, they're using AI models to help them figure that out. Because let's say your commercial space is divided, into units that are 15 by 40 feet. Tough to put an apartment in something like that. Yeah. It's great for an office, but not so great for an apartment. And so deciding on how much gutting of the building is financially feasible to still come out with a profit at the end is pretty tough. And so not all commercial space is going to be suitable to do that. However, that's a great solution for as much as we can make it happen. Yeah. The only way that that's going to really take off successfully is with local and federal subsidies to help assist the developers, builders, etc., to make that happen. Ultimately, the shortage of housing in the United States is so severe that the impact that potentially is available in providing residential space from, available commercial space is not enough to make a significant difference. It all goes back to the 2008 financial crisis. Even before the crisis, there was a little bit of a housing shortage, but then once the crisis hit, builders have been gun shy ever since then, and cost of materials have been high ever since then. And ever since 2008, they've only amplified the housing shortage in this country. It's gotten pretty bad. Consumer sentiment.
Yeah,
go ahead.
After you.
Well, consumer sentiment on purchasing a home, as it is at a historical low. Only 21% of the population thinks it's a possibility. It's pretty interesting. It makes me think of an old quote on, how to build wealth. You build wealth slowly at first, and then you lose it all at once. So, yeah, you build wealth slowly, but you lose it quickly. And one of the challenges today is for Gen Z and even millennials being able to build wealth through real estate. That's becoming more and more difficult. That consumer sentiment number I mentioned at 21%, it's never been that low before. It's always been above 50. But over the last 12 months, it's dropped pretty dramatically. And that has to do with the run that we had with the values of commercial real estate. And then we had a similar problem that China's facing today, and that is coming off of zero interest rates, from the central bank, moving to what Jamie Dimon calls normalized rates, because I got to tell you, anything between 6 and 7% for a mortgage is a normalized rate. Sure. But because we've had such low rates for so long, the entire population is having difficulty adapting to that. So.
Naturally, yeah. Well, speaking of China, why couldn't we just get some of the labor force that the developers that were building ghost cities out there over here,
Yeah. They need something to do, that's for sure. Yeah. No, China has their own funny little difficulty. Now, China has the opposite problem as the United States. They have a housing bubble, not only because it's the market's overvalued, but because they've overbuilt, like you mentioned, they have ghost cities in China. That was all stimulated by the government, and now it's working against them. Mm-hmm. And China has an additional problem that they're trying to deal with right now, which is they're trying to pay off debt. And I'm not talking about the federal government in China, the People's Republic of China, but I'm talking about the local municipalities, right, private entities, as well as individuals. They're all trying to pay down their debt, and they're cutting back spending, and that's impacting the Chinese economy. Yeah. It's reducing their GDP. The Chinese government, as a matter of fact, reduced one of their key interest rates. It's the seven-day purchase option. It's a rate that banks, they can temporarily borrow money from the Chinese government. They reduced it from 2.0 to 1.9, trying to stimulate the economy, which is interesting. Their central bank is reducing rates when the rest of the world's increasing rates. There's a problem with that.
Right.
That's a problem with that. Right. That's going to devalue the currency. That's going to devalue their currency.
Yeah.
They're trying to stimulate their economy, but ask Turkey how that worked out for them. It did not.
So Japan is one of those countries that is over leveraged on their GDP, but they also experienced extraordinary inflation a couple of decades ago. I had stopped in at an office and asked about some of the real estate options here, because in certain cities you can pick up a home very affordably here, as well as to understand what the buying rules are for foreigners. But interesting takeaway was that the Japanese government, while they did and are still dealing with the effects of the inflation that they dealt with in the 90s, their focus and their reaction to that has been to never allow a bubble like that to happen again. And so the rules that they have available as far as lending and loan land ownership is for the intent of maintaining affordability for its residents. And so while people do own property and sometimes take out loans, they don't do it in the traditional fashion like we were aware of. They'll pay the higher rate to pay off the property sooner and keep it within the family, because the ownership, the value is in the land for them. It's not in the building. The building, they can tear it down because there's so many older units, older constructed units. The older it gets, the more maintenance it requires. So they want to replenish that with new supply, getting it rebuilt, and with the newer structure that will obviously take care, withstand earthquakes and some of the issues they got here. But I really like that takeaway for them here in Japan, at least from their economy, is like their focus is to never allow those bubbles to be fabricated. They want to have some sort of control on that. How that's working out, we'll see what happens, but
what moved China into that situation is during the 80s and 90s, they did what China did recently, and they exploded their debt back at that time. And what really hurt Japan was they're having to deleverage, and that's what's dampened their economy for the last 20 years is all the deleveraging they've had to do. When major economies, national economies, have to deleverage, out of the last 44 major economies that have had to deleverage, like Japan did and like China's trying to do right now, 36 times it's led to pretty major recessions in each of those economies out of 44 different times. So when a major economy has to deleverage, it causes problems, because think of your own home. If you decide as a household, I have too much debt, I'm going to stop spending and pay down my credit cards. Well, when a major economy stops spending, that causes, that causes the GDP to contract. And the less money a government, the smaller the GDP, the less money the government has, to expand its economy or even care for social services. And that's what China's dealing with right now, is deleveraging. And that's what Japan had to do. And that's what they're trying to prevent from happening again. Yeah. And so last part about China, though, because this is, I would put commercial real estate as the next potential crisis, but one that's kind of down there. And it could happen. I don't think it's as imminent as commercial real estate here in the United States, but it's the Japanese real estate market. We've always talked about how it's overbuilt. The Chinese government, Chinese. Thank you for correcting me. Thank you. The Chinese real estate market is way overbuilt, and the government in China will not allow the developers or builders to sell those properties for less than what the government values them at, because the government is trying to prevent a real estate collapse. And real estate actually has gone down in value year to date so far in China by 13%, and the government's trying to prevent it from going down any further. So they're restricting the builders and developers in that country from selling what they think they should sell at. And that's the difference between a free and open market and one that's sort of managed by a central government. And I'm not suggesting one's better than the other. I'm just stating the differences. And so if you have a property, to illustrate, in China that you as the developer can only sell for $85,000, but the government says you're not allowed to sell it for less than $100,000, that property's not going to sell. So they came up with a solution, kind of a funny solution. If you buy that property for $100,000 from the developer will then give you a gift of commodities. In this case, the commodities will be gold of $15,000, which can be quickly converted into currency.
Sure.
They can't give you a cash bonus back because that will automatically reflect the value of the property at $85,000. So they sell it for $100,000, and you simply get a kind gift of gold of $15,000 back. Creative. So that's what's going. Yeah, creative. But the reality is, what that means is values in the largest asset class in the world, the Chinese real estate market, are dropping, and that's got to have a rippling effect to the rest of the global economy. But
wait and see.
We will see. That's the wait and see thing. Yeah.
Yeah. Well, Mike, before we wrap it up, you got anything else to add to this?
Well, just again, watch for the Fed tomorrow. Basically, I don't think the Fed is going to make a move tomorrow. It's going to be a pause. But in their comments, look for them to talk about how it's only a pause. They're going to make sure that their decision tomorrow allows regional banks to sustain themselves and not have any sort of crisis. And they're going to allude to the fact that if core inflation doesn't come down, then they will anticipate more hikes this year. And personally, based on the rate that core inflation is going down right now, I see 2 more hikes this year, which will put us at 5 3/4 as a central bank.
You heard it here first. The real estate and the economy this week. Mike is calling 2 more movements later this year.
Sometime this year, yeah.
Very good. All right, my friend. It's always nice to get your insights. Thank you so much for joining. And that does it for this episode. If you would like to get a daily update, a daily newsletter on the insights of the economy today, make sure you connect with Miguel Francis on LinkedIn, where you can subscribe to the newsletter and get an updated report every day, free of charge, no cost. Simply connect with him on LinkedIn, or you can click on the link below in the comments. Not the comment section, but the description section. We have a link to his profile page there.
I'm sort of simplifying it. I'm calling it Mike Francis, the Blind Economist. I'm trying to make it easier for people to remember. So.
Awesome.
Yeah.
Very good, my friend. Thank you so much for your time. Look forward to seeing you next week in person, in studio. Back to our normal routine, man. That does it for this episode of Real Estate and the Economy today. Thank you so much for joining. Make sure you click on the subscribe button or share. If you found this helpful, be sure to drop in some comments. We'd love to be able to get some answers for our viewers. Look forward to seeing you all next week. In the meantime, take it easy.